Good morning. Welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Patakia and Reema Tendulkar. Good morning, guys. Well, we were just discussing it's already the monthly expiry. The time's flying. But we start the show with Nifty at the day's low. We started on the back foot and that has continued to be the case as well. But the last hour will, of course, be very important for our trading session today because that's when we see a lot of volatility. There could be a recovery or we can see further sell-off from these levels. For now, a 100-point downtick on the Nifty. It touched those days low levels, saw a wee bit of a recovery from there. The mid-caps, which were outperforming yesterday, they are down 0.2%. Bank Nifty is the one which is leading to a lot of losses today. It was a big support yesterday, but today at the day's low as we speak. Metal index doing well. We have autos which are supporting as well. PSU banking index, that is one space which continues to be on the front foot. That one is also in the green today, but that also has come off from the highs of the day. But all in all, we have to say that today continues to be a crucial day. We have the expiry, then a lot of earnings that we are tracking.
Indeed. And in the banking pack, it's HDFC Bank and State Bank of India. If you pull up that intraday chart, you will see the slide in these stocks in the last 30 to 1 hour. But so many individual stocks are already reacting to numbers. We'll discuss them on the show. But look at the Canara Robeco. Very disappointing margins. Stock is down close to about 7%. On the way up, you have a JK Tyre, you have an Indus Stars, and Sai Silk, which Hormis will also be discussing in Midcap Spotlight. In fact, that gives me the cue to toss it over to Hormis now. Hormis, what's on your buzzing stocks list this morning?
Well, earnings reactions are dominating the list today. It goes without saying because there are enough and more positive side on the negative side as well. But we choose to focus on the positives. And you mentioned the two top performers on the small cap index today are earnings reactions. Suraj Estates is one of them and Sai Silk Kalamandir is the other one. Now, Suraj Estates, you take a look at the volumes here, 30 lakh shares have already been traded, almost 35 lakh shares. The 20-day average here is only 24,000 shares. Now, even for Sai Silk Kalamandir, the stock has been buzzing in the last few trading sessions, and even after the earnings, the stock is up double digits today, and 2.5 crore shares have been traded on this stock already in the first 2 hours of the trading session. The 20-day average here is only 10 lakh shares, and Hatson Agro, after the 20% upper circuit yesterday, is building onto those gains and is doing well for itself today as well. Now, the metals is one pocket that is doing well even as the market is not doing so well today. Welspun Corp, GSPL, Tata Steel, look at the volumes here as well, and Tata Steel has received its third bullish reaction in the last 5 days, and that stock is among the top gainers on the Nifty today. And JSPL, of course, reporting earnings today and almost 6 times its 20-day average in terms of volumes. And the stock on the list that I wanted to focus on individually was Spark. Sun Pharma Advanced Research is up 8% today. It's gained in 5 out of the last 6 trading sessions. And volumes in the first 2 hours itself are already at the highest level since May. So it's almost at a 6-month high already. We've had over 40 lakh shares that have been traded on Spark in the initial bits of today's session. The 20-day average here is less than 90,000 shares. It's not 8,700, it's 87,000. And the stock is now nearing its 100-day moving average, which is at 147, and the next important level to watch is the 200 DMA, which is at 149. And this, of course, is the first monthly gain that the stock may see after 4 consecutive months of losses. And despite this, the stock has been an underperformer this year, down 30%, and was down 30% in 2024 as well. So among the top gainers today, Spark, but has been an underperformer in 2025.
Take that point. Thank you so much for joining us with those interesting names, Hormis. By the way, just taking a look at some other stocks as well. We do have NetWeb, which is up 5.5% as we speak. Tata Steel is the other stock which is higher, 2.5%. Of course, Metal Index is the top sectoral gainer today. Tata Steel is one of them, which is pushing that index higher as well. Indus Towers, we'll discuss that in greater detail. 2.5% higher on that one. That's a big story as well. But Bata India, that is on our radar, reported decline in consolidated net profit for its Q2. The weak quarter was also hurt by GST transition. We have the analysis coming in from Mangnam, who's joining us with more details on this.
If you look at Bata, this quarter was marred by a lot of one-offs, and it was actually a quarter where a lot of things went wrong for the company. Starting with July, where one of their major warehouses saw some disruption, so that impacted their sales. Add to that, we had the GST, announcement that came in, which while it's a structural positive, but remember 80% of their portfolio has had to take rate revisions, and as a result of which there were stock-related transitions that impacted their overall sales. And to do all of that, to do away with that stock, the company had to liquidate that inventory, and that hurt their margins as well. So revenue was impacted, margins were impacted, and eventually the bottom line was further impacted by them taking some immediate upfront cost measures like that of VRS. So there was an 8 crore hit that came in on account of that as well. So as a result of all of this, the net profit of the company fell by over 70% on a revenue decline of 4%, and there was a decline of nearly 17% on their operational performance as well. The management said a couple of things, and as a result of which the stocks recovered a tad from the lows despite poor performance coming in the quarter. The first part was that the premium part of the business is doing fairly well, which accounts for nearly 30% of their sales, can be up to 40% over the next few years. And secondly, they have seen a good festive season, so sales are likely to see a bit of an uptick. They are doing portfolio refreshes, store refreshes, and at the same time, from a cost standpoint, they believe that they've extracted all that they can, and going forward, any incremental uptick in revenue would flow down to their EBITDA, and that would cause further operating leverage benefits, and they believe that margins would recover back to over that 20% mark as well. So all these factors have caused some relief in the stock from the lows, but it's still trading about 3% lower.
Thank you very much for that. Moving on then to the EMS companies, Keynes Tech and Syrma SGS are also surging after MeitY approved the first batch of component manufacturing projects. Upasana joins in with the details.
Well, certainly, the Ministry of Electronics and IT has approved 7 projects worth 5,500 crore under ECMS involving manufacturing of copper-clad laminates, PCB and even camera modules. Now, let us look at the key beneficiaries here. Keynes Circuit, which is a subsidiary of Keynes, has received approval in all the categories they have applied, which is multi-layered board, HDI boards, camera modules and even copper-clad laminates. Now coming to Syrma Strategic Electronics, now Syrma and Amber has received approvals in only one category versus the various categories that they had applied. They've received approval for multi-layered boards. Hence, we can certainly see both these stocks surging in trade today. Now, Elara Capital is of the view that the companies which are likely to benefit on the back of this, as mentioned earlier, is under ECMS is similar to the PINI and is subject to meeting the requisite criteria. It expects players like Dixon Tech, PG Electroplast and other EMS players also to benefit going forward once the approval for the second tranche comes in. It believes that this will help to continue the growth momentum seen in EMS sector as a whole, especially once the PLI ends in March 2026. So overall, if we see, Keynes and Syrma certainly in focus on the back of this.
They're both doing well for themselves as well. Upasana, thank you for that. In fact, hear out the management of both the companies as to what they had to say on this scheme.
Manufacturing is concerned, our land we have acquired, our building has come up already. We are almost in the completion stage. Whereas machinery we have ordered, it is in the pipeline. So considering all these things to meet the timeline what ministry is expecting, we will be there well within the timeline.
The first application is for multi-layer PCBs. This would be a plant with a capacity of 2.5 million multi-layer PCBs at full capacity with a targeted investment of about 765 crores. It is coming up in Andhra Pradesh. We expect to start the construction somewhere next month. I think in coming years, India will become a hub of component manufacturing. I think this is a very, very commendable step.
All right, that's the big step. I believe 249 proposals were received, and of that, 7 were selected, and the beneficiaries Upasana spoke about. But moving on, Sona BLW has delivered a beat in the second quarter, largely driven by revenue growth from the rail business consolidation. Sudarshan joins in to explain what happened and what brokerages are saying.
So in the opening hour of trade, Sona BLW at one point was up almost 3%, but now it's trading near flat line. And the reason first why it's in the green. Earnings have come in largely higher than estimates. All the headline numbers, you talk about profit, revenue and EBITDA, all these numbers have seen a double-digit growth. Margin has slipped 200 basis points, but it's much higher than estimates. Estimate was around 23.8%. Company has reported around 25.3%. The reason it's failing to hold on to the gains is because the JV that company had announced with a Chinese company in July of 2025, now that announcement or that JV announcement investment has been put in the abeyance. And remember, there was an expectation that through that JV, the client that company was going to serve was BYD. So that is also weighing on the stock. As far as brokerages are concerned, most of the brokerages remain positive on the stock. CLSA maintains outperform call. Target is 570 per share. And the main positive thesis by CLSA is there are three main competitors of the company in the Europe, and all the three competitors have filed for insolvency, which might lead to a big order wins for Sona BLW. That's one of the major reasons that why CLSA is positive. As far as Nomura is concerned, it also maintains buy call and target is rupees 605 per share. It says company has delivered very well in the tough times, and also Q2 revenue beat was led by railways and traction motor, and potential for major order wins is very strong going forward. And also on the valuation front, it's finding very comfortable or reasonable.
Take that point, Sudarshan. Thank you so much for joining in. So that's about Sona BLW. But with that, we'll slip into a break. When we come back, we'll focus on the crypto market with Manisha Gupta on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back on Crypto Corner. We're talking about the month of October, which also is called Uptober when it comes to crypto as a lingo there. But that doesn't seem to be working out in 2025 till time, because in the month of October in 2025, cryptos are headed for the weakest October since 2014. October has been a bullish month in all of 10 years out of 12 years that we have seen, and 2025 clearly is not going the same way. An average return that we've seen on Bitcoin has been 20% for the month of October. When you look at, and this has been the case for the past decade, by the way. So just take a look on how October clearly has been for Bitcoin in last many years. So when you look at 2013, we saw Bitcoin gain up by 60% in the month of October. It was 50% of gains in 2017, another 40% of gains in the month of October itself in 2021. Even last year, even as it wasn't so bullish, but we did see 10% of gains for the month of October in 2024 as well. In 2025 till time, Bitcoin is trading in the negative because the high that we saw in this month was $126,000. That was on 6th of October. Now today it's trading at 105,000. So we have seen a very sharp decline come in within the month of October itself. So much so that October has seen nearly $20 billion in leverage trade being wiped off when it comes to trading within here. That's one thing about October, but October clearly seems to be going down with a lot of new various things as well, newer partnerships also. So when it comes to Web3, blockchain, especially stablecoin, we are looking at a lot of good news coming in that front. The latest has been Citi and Coinbase teaming up. This is done to explore stablecoin payments going forward. Now, on-chain stablecoin payments are expected to enhance speed, efficiency, and programmability as well. We have seen US do quite a bit in sense of regulation when it comes to stablecoin. Also, the Genius Act has been all about stablecoin, so much so that we've seen billions of dollars being done every month when it comes to stablecoin in sense of transfer of funds there. Coinbase now, of course, is working with more than 250 financial institutions worldwide, and Citi is just one more added to that list.
Take that point. Some interesting updates there from the crypto space. Thank you so much for explaining that to us, Manisha. By the way, Car Trade Tech's numbers at the bottom of your screen, 8.5% higher on that one. The EBITDA is strong, up 95%, and we do have profits which have grown as well. But that's about the crypto space and also what's happening with individual names. But trading is delayed again in MCX. There are tech issues. Manisha, tell us more about it. What's happening here?
Well, absolutely. And not very nice if you were a commodity derivative trader there, because the kind of decline and moves that we are looking at in gold and silver and nowhere to trade. Because remember, MCX is 98% of overall market share when it comes to Indian commodity derivative trade there. Now, what we do understand is that the commencement of trade has been delayed at this point in time. The last time that happened was in the month of July. And the second time it's happening in last 4 months itself. When it did happen in July, it was a delayed start with nearly 1 hour and 10 minutes. But today, remember, the exchange is expected to start at 9. We already are at 11:15 right now. So it has been 2 hours and 15 minutes. And we still do not have a confirmation from MCX on when the trade will actually begin. What MCX has continued to tell us since morning is that the commencement of trading is delayed because of technical glitches or issues there. And the trading will, as and when it starts, will be from the disaster recovery side. We also do understand that the time of commencement of trading will be informed. So we still are awaiting for further delays there. But we have spoken to a lot of brokers and they tell us that for last many weeks, months even, there are the confirmation when it comes to putting orders has been delayed. There also is late arrival of settlement fees, etc. So those informations, there have been concerns there. MCX has TCS as a technical partner there. And there have been concerns, as we've seen in last 4 or 5 or 6 months therein. And this is the second straight time in 4 months that we are looking at a delay with MCX yet to begin trading today.
Manisha, thank you for that update there. More delays coming in for MCX. The stock has also slumped to the lows of the day. And just pull up BSE as well. That too has now declined to the lows of the day, 3.5% lower on that stock as well. And just before we take that break, look at Car Trade Technologies. We just spoke about the numbers, 12% higher now on that stock. And margins have seen a 12 percentage point jump from last year, 33% from 21% last year. So 11.5% higher on Car Trade Tech, almost 3,000 now, and is almost nearing 8.5 to 9x jump from the all-time lows that the stock had hit.
It's doubled this year itself.
You know, a lot of funds are also showing a lot of interest in Car Trade Tech. You had Mobius Partners who also bought a stake in this one. But we'll do one thing. We'll slip into a short break. Management of Heritage Foods will join us next to discuss the latest acquisition of dessert maker Getaway.
Welcome back. We have with us Money Control's Super Pro expert Dhwani Patel from Finversify, a SEBI-registered market professional who tracks market movements and helps identify trade-worthy trends for Super Pro subscribers every day. Dhwani, thank you very much for joining in. Quick word on the market, the profit booking that we're seeing, and your technical ideas, trading ideas for the day.
Good morning. Definitely, yes, we're seeing a certain profit booking coming in on the index right now. 26,000 on the higher side in the Nifty is acting out as a resistance, but this looks like a short-term resistance over here. Once we cross 26,100 on the higher side on closing basis, there's a positive bias that continues towards on the index over here. Bank Nifty also is showing certain laggard performance as compared to the Nifty over here, but then having crossed on the higher side 58,500 mark, we'll be seeing further action coming in on both the indices. So the view over here remains buy on dips in both the indices. And on the technical side, I'm eyeing up on two counters over here. The first one is from the metal index. We're seeing that metals are gaining in the session today, and in today's session, SAIL, Steel Authority of India, remains in focus over here. On the daily structure, we are seeing a demand zone over here around 128 levels. From there, a constant buying interest is being shown. On the higher side, the targets for this one extends up to 138, and on the lower side, 128 remains as a stop loss over here. And the second counter is one of the new age tech companies over here, where Eternal has been showing a buying interest on the lower side from 320 levels, and currently we are trading on the higher side. In the last two sessions, the buying interest has been positive. This is there to continue further till 355 levels, with the stop loss that one needs to maintain on the lower side at 325.
Take that point, Dhwani. Thank you so much for joining us. That was an insightful session. And for our viewers who want to access these kinds of actionable insights daily, check out Money Control Super Pro, where market expertise meets technology. Subscribe now and get an ad-free, data-rich and globally connected experience. And here's a festive bonus. 10 lucky subscribers every day stand a chance to win gold coins. Just scan the QR code on your screen or download the Money Control app to know more. All right, with that, let's move on and focus on a corporate conversation. Heritage Foods has announced acquisition of 51% stake in Getaway. The company's CEO, Shrideep Keshwan, joins us now to discuss more on the same. Mr. Keshwan, good morning. Thank you so much for joining in. You have announced the acquisition of a 51% stake and will also be acquiring 20% more stake in the company. At what valuation will you be buying the remaining 20% stake and by when?
Thank you very much for having me on the show. Good morning to everyone. See, before I answer that, let me just give you a context of this acquisition. It was earlier this year that as a company, we announced our ambition to be the most admired dairy nutrition company in the country by 2030. And this goes by several objectives that we had laid down in this regard. And this acquisition is very much aligned to that. And one of the topmost reasons why we have gone in for this is that this helps us make our ice cream portfolio, which is the fourth biggest category that we are trying to build in our value-added product portfolio, a double engine for growth. And the answering specific to a question, the remaining 20% that we are trying to acquire in the month of March, what we've agreed on is a business performance linked pricing.
Got that. What's the size of the healthy dessert market right now? And I think the acquired company Getaway's revenues last year were 18 crore. Once you come on board and you scale it up with your distribution, what would the revenues look like since you want this to bolster your overall ice cream business? I mean, what are the projections that you've made when you went ahead and made this acquisition?
Yeah, sure. See, the healthy desserts is still a very small category, but it is growing at a breakneck speed. Just to give you a sense of it, you mentioned that Getaway as a company did 18 crores of revenue in the last financial year. That's a number that they've already achieved. In fact, they've exceeded that number in the first half of this year itself. And we expect this rate of growth to continue for several years to come. At this point in time, I believe that healthy nutrition or healthy desserts category is just about 1 or 2% of the overall ice cream as a category. But this in the next 5 years could eventually become even 10% of the category. What's more important for us and what's interesting for us is that this gives us access to the new age consumers, especially the Gen Zs, who are driving consumption and who will define consumption for the next 5 years or so. It is expected that Gen Zs would be influencing about 50% of all consumption choices by FY 2030.
Mr. Keshwan, good morning. Thank you for joining in. You mentioned that this healthy desserts market could go up to 10% in size from the 1 to 2% currently. Are you seeing that kind of interest that is prompting you to make such a projection? Because for a lot of us who are fond of having desserts, we would not want to involve a healthy component in it.
See, Hormaz, thanks for asking that question. It's actually a very important one. Let's take a step back and understand this category, right? Where is this growth being driven by? There are multiple forces that are aligned here. First of all, we should understand the channel in which it is selling. Getaway is actually a major player in one of the fastest growing channel that we have today, which is quick commerce. They in fact actually have 10% of the share of ice creams within quick commerce itself, which is quite significant, right? And quick commerce as a channel is helping consumers discover many of these new trends. The second most important thing that I would like to talk about is what is special in Getaway's portfolio. Getaway's portfolio is made, all of their products are high protein and zero sugar. Now, protein is a trend that we are seeing for some time, and it is actually going to stay for quite some time to come. These are not trends that are just emerging out of the blue. We have seen this trend for the last several years in the Western world, and even in India for the last 2 years, it has been tracking. The most important aspect here is that what we really love about this business is that these people have been able to craft ice creams with a lot of love, and it is not very easy to create a high protein ice cream, low sugar, which is indulgent as well. The products themselves are heavily indulgent, which is the reason why they have one of the highest stickiness rate in these modern channels. If I could just quote some of the numbers, In quick commerce, they have repeat ratios of about 35 to 36% across all channels. In food service, such as Zomato and all, their repeat rates are as high as 45%. These are not small numbers. And also, I also spoke about the kind of growth rate that they're tracking. With these kind of numbers, we are convinced that we can win in this particular segment. If I could just also remind the viewers, it was about a year back, exactly in this channel, that we had announced a capex of 230 crores to expand and build a new greenfield facility for making ice creams for ourselves. So this acquisition, actually, which is about roughly 30% of our ice cream portfolio itself, so it not only expands our ice cream portfolio, but it complements it in every way. That is the reason why I said that this is going to be a double engine for growth as far as our ice cream portfolio is concerned.
Take that point. So it is going to complement your ice cream portfolio and will lead to growth from here on. That's about the acquisition that you're making, and will buy another 20% stake in this company as well. Generally on the business, I wanted to understand, what is the outlook on procurement prices? We have seen the sector buzzing post results. We are seeing that Milky Mist has received a SEBI nod for the IPO as well. What are the general fundamentals that you're seeing in the sector and the space right now?
The sector continues to be strong. This year we have had extensive monsoon, which was actually a small air pocket, as I would call it, in this long journey of growth. On the procurement side also, we have seen slight inflation in terms of prices. On the commodity side also, we are continuing to see a kind of inflation. In the first half, if I could just give some numbers, the milk prices were up about 6.3%. And this, in fact, impacted the bottom line of most players as well. We have seen our EBITDA come down by about 1.8% on a like-to-like, year-on-year basis. But we are confident that we are now, as we are entering the flush season, all fundamentals remain strong. On the demand side, we are seeing strong demand, except for the weather vagaries that we are seeing. And with the flush season coming in, we expect the procurement prices to cool down. And that's going to be great news for the industry.
Very interesting product, Shrideep. I was just checking the website. So the Belgium chocolate ice cream, 100 ml. Calories are 106. That's less than half of what you would get in a regular ice cream. And 8 grams of protein. Must try this. Thank you very much and all the best. Wish you all the very best. That's Heritage Foods for you. We'll slip into a break. On the other side, more on the market. Stay tuned.
Welcome back. Still 100 points lower on the index, trading in a very narrow band, although there is some profit booking at higher levels. Good time to get in Mangalam, who is at the FNO desk with the latest trends on the monthly expiry session. Mangalam.
A couple of things are becoming clear. While we're finding support at lower levels, staying above that 26,000 on the frontline index seems to be a bit of a task for the bulls. And that's exactly what we've seen over the last 3 or 4 trading sessions. In fact, every time we've gone past the 26,000 mark on an intraday basis, we've retraced from that, and that's taking place today as well. So case in point, you have the October 28, which is today high of 26,041 on the Nifty. Yesterday's high was 26,006, a little over 26,000, and all of that after the sell-off that we saw on October 23rd of 26,104. In fact, all these occasions, the Nifty actually closed below that 26,000 mark. So not only crossing 26,000 is important, but closing above 26,000 is equally important. And ahead of expiry, for the last 2-3 days I've been telling, even as the market is moving higher, the India VIX has moved higher as well. It would have been a lot more comfortable for bulls had the India VIX been moving lower, and a large part of the up move yesterday and the few occasions was on account of the shorts covering their position, especially on the options side. So today as well, even as the Nifty's moved off the highs, we have the India VIX, which is now around that 12.5 mark. So that's something we will monitor as we move towards expiry. its inability to cross past 26,000 has had a lot of these bears ride the 26,000 call for a premium of almost 16-17 rupees right now. 3.5 crore shares outstanding there for the ones that expire today. So crossing past that 26,000, if it happens today, will lead to a lot of short covering. But bears don't believe that will happen. They have written calls out there. In fact, not just there, they've also written calls at 25,900. So that's something that we will be watching out for. And at the lower levels, however, there is some support coming in, and that's because there is a lot of writing that we've seen at 25,850 put and the 25,800 put. Both of them seeing a serious amount of writing as we move towards the expiry session. So all in all, it looks like a range-bound session after a series which has seen over 1,350 points in terms of an up move coming in. And the option writers see this expiry range at 25,750 to 26,050. My sense is it would be further narrower than that. 25,800 to about 26,000 or 25,950 thereabouts is the range that the option writers would be looking at.
All right. Thank you, Mangnam, for joining us with all those details. With that, we'll do one thing. We'll slip into a short break. When we come back, management of PDS Limited will join in to discuss their Q2 numbers. Welcome back. Let's focus on PDS Limited in Q2. The company saw its revenue grow by 3%, but the net profit declined by 55% and EBITDA by 28% versus the last year. Sanjay Jain, Group CEO, PDS, joins us now to discuss the numbers and the outlook going forward. Mr. Jain, good morning. Thank you so much for joining in. Can you give us a sense of what the outlook is for FY26? What led to this profit decline this time around? And revenue growth came in at around 3.4%, which compares with Q1 revenue growth of 14%. Why was it lower on a YOY basis, and what's the outlook?
Hi, morning. I think these are very turbulent times, as you know, word over, given the tariff situation that has prevailed and also the retail sector in general in US and Europe being under pressure. Despite these challenging times, PDS, has tried to stay on top in terms of an 8% growth in terms of H1 over the same period last year. Yes, in Q2, we have a growth of about 3%. But what is important is that our order book today stands at about 5,300 crores, which is almost 15% up as compared to same period last year. So therefore, A, we've been trying to stay on top of the challenging times. B, entering the second half with a 15% growth in order book. In terms of profitability, I think there are two factors to it. One is for us, what is important is to stay engaged with the customer. If the customer has been facing pressures for the reasons I just mentioned, can I participate with them even if I have to pass some discounts to them, or even if I have to absorb part of the cost? That is on one hand. Secondly, we have invested close to 80 crores in terms of investment in new verticals, and they are under gestation phase. If I talk about the new verticals, while on one hand you experience a growth of about 4% overall, but the new vertical growth is about 46%. These are aimed at new geographies, new line of activities. So as two things, as the order book start unfolding into revenue, as we aim to cut the investment in new verticals by about 25% in H2, we believe the second half should be better than the first half of the year.
Sanjay, a couple of questions. Last time you gave a guidance, FY26 revenue growth to be in mid-teens. 8% done in first half. Does this FY26 guidance hold?
I think as I said, nobody had foreseen what happened to tariffs in the last 6 months, but what is important is the order book mid of the year is 15% up. So, we will keep a watch on how things unfold. We've been reading that India and US are likely to settle the tariff, interface very shortly. But what is important is walking in with a 15% growth. We'll keep a close watch as to how the H2 unfolds.
Okay, so you're unable to commit to that mid-teens revenue guidance as things currently stand right now, I guess. What about on margins? Because you are undertaking a lot of steps. There is cost optimization at the corporate level, the turnaround at New Lobster, even certain business verticals you're trying to restructure. What could be the exit margins that you're looking at the EBITDA level and PAT level, say this year and next year?
There are twofold measures that we started, A on balance sheet and B on the P&L, things that you just asked. I think in the first 6 months, the balance sheet initiative has already started unfolding into results. We generated strong 590 crores of free cash flow operation in the first 6 months. Is because of the working capital squeeze that we started on one hand, and secondly, restraining on investment. So that I think is already unfolding to results. On the second bit, which is a P&L related initiatives, as I mentioned in response to previous question, we invested into growth. The growth investment is through P&L. It is about 80 crore hit in the P&L in the first half. We are aiming to bring it down by 25%. On one hand, that is an initiative. Secondly, we engage the services of BCG to try and help us improve our processes when it comes to procurement efficiencies, etc. We've come to near finality of their assessment. And as we start implementing this in the second half, we expect an improvement in the overall EBITDA margin as well as the profitability of the company. One should see at least minimum 1% improvement in the margins in the second half as compared to the previous half of the year.
Mr. Jain, you spoke of gestation periods. How long is this likely to last for your other businesses that are currently in gestation period? Now, once that gestation period ends, how does that improve your balance sheet? And and almost a quarter of your top line comes from the US markets, right? So in the middle of all of these uncertainties, have you tried looking at other geographies to diversify that 25% and try getting it from other areas?
See, all things remaining same, typically it takes about 18 to 24 months in terms of any new investment to start giving a PBT break-even. But we know that last 1 year has seen disruption in Bangladesh and then the tariff issue. So therefore, it is taking on an average 1 year longer than we anticipated. But we believe we are on the path now to start gradually inching towards a break-even. We said 25 to 30% reduction this year and next year about 50%. So therefore, to precisely answer your point, whatever investments we have committed to at present, I think in about 18 months, we should expect them on an average to be PBT break-even. That is on number one. And I think on geography, we've actually had a lot of focus in the last 18 months on US market. And in fact, in the first half of the year, our growth to US markets have actually grown up about 25% as compared to the same half last year. If I just annualize what we did in the first half, we should do at least about 2,500 crore of sales to North America. So I think that's something as a heartening sign. In our kind of business, as we inch towards growth, all these investments actually go through P&L. That's why one observes. And one more point I want to mention that if I draw a trajectory of the last 5 years of PDS, the last 2 years have been into an investment phase, into new verticals, into new lobster. But prior to that, as in the first year 5, 4, 3, as we were harnessing what we invested, our PBT margin inched to about 3.5%. So therefore, in the next 18, 24 months, as we work towards monetizing, harnessing our investments, that's the kind of potential that is there in the PBT trajectory of the company.
So does that also mean that your capex, which is reportedly down 50% in the first half, does that see a recovery in the second half? And debt has gone down as well. So does that continue to trend down as well going into the second half of the year?
Yeah, it would be our serious endeavor that we continue to contain our debt in the second half of the year. We've already brought it down to the levels you have seen. On the capex, last year we have seen significant investment into our PDS tower in UK and some of the other capex. This year, we clearly see a reduction in that. I think the next 12, 18 months, our focus is curtail investment. That's lesser of a focus. We are curtailing, but a bigger focus is we invested. Let's focus on harnessing what we're investing into.
All right, Mr. Jain, thank you so much for sparing time and joining us. Wish you good luck for the second half of the year as well. The management there of PDS expecting the second half of the year to be better than the first one. But here's a quick note for our viewers. If you would like to access expert-driven insights and actionable chart patterns, simply scan the QR code on your screen and subscribe to Money Control Super Pro and get daily expert calls, actionable charts and insights to power your investing decisions. Plus, the festive season, there is more reasons to celebrate. 10 lucky subscribers every day win 1 gram of gold. So don't wait, scan, subscribe and make your portfolio shine brighter with Money Control Super Pro. Take a short break, back on the other side.
Welcome back. You're still tuned into Trading Hour. Well, let's talk about the big story for the day. Indus Towers is on our radar. It is higher for the second straight day on the back of numbers, and of course some relief that is coming from Vodafone Idea as well. Rima, let's talk about the numbers first. How did they look?
So numbers have two positives. One, an EBITDA beat. And the reason for the EBITDA beat is that the company kept making provisions for the receivables from Vodafone Idea. But Vodafone Idea has been fairly regular with it's been regular with its monthly payments to Indus Towers. So therefore, every quarter the company has been reversing part of the receivables. So in Q2, they reversed about 195 crore, which is higher than 88 crore that they reversed in Q1. And that led to the EBITDA beat. But even if you strip that out, according to analysts, margin performance was strong. And the second positive was the tower addition accelerated to 4,300 in Q2 versus about 2,500 in the prior quarter. But the other big reason which you guys spoke about, the second reason why Indus Towers continues to see action is the relief on Vodafone Idea. Remember yesterday, Supreme Court said that the government now has the flexibility and the power to provide relief to Vodafone Idea on AGR dues. Now it's up to the government what form and shape the relief comes in. But the end goal will be that Vodafone Idea emerges stronger. One, the cash flow situation improves because immediately the AGR dues that they own to the government will perhaps reduce or come to an end if they get a moratorium. But secondly, maybe the company is able to even raise bank funding. So the cash flow improves. Once Vodafone Idea's cash flow improves, it can spend on capex. They wanted to spend 50,000 crore on capex. So now they can go ahead with that. Where is their capex? To a company like Indus Towers in terms of tower additions and getting tenancy there. So therefore, when Vodafone Idea gets stronger, Indus Towers benefits.
Indeed. So, and as a result of which a lot of these brokerages have also given upgrades, raised their targets. They're hoping that the dividends will resume as well. So what lies ahead now for Indus Towers?
I think the big thing is in terms of dividend. Right? The hope was, earlier you used to pay dividends, right? Then they stopped because of the issues surrounding Vodafone Idea. Then you got a sense that Vodafone Idea is improving. Then the company formed a committee to look at reinstating the dividend. But then nothing happened after that. 2 quarters back, that committee was formed, but they're still sitting on it. Then last quarter, you got the news that they're foraying into Africa. So that further put a question mark on when dividends will come in because there is going to be cash flow diversion for Africa. So, now that, Vodafone Idea is going to emerge stronger, when do you think the company can resume dividends? I think that's the biggest re-rating trigger. There is a conference call today. According to IIFL, there is a possibility that towards the end of FY26, we could see the company reinstating dividends or a buyback. But you spoke about brokerages and how they're reacting. Jefferies today has upgraded the stock. They say that expect a 6% profit CAGR plus a dividend yield that everyone's expecting, right? That would be 7%. So therefore, the risk reward looks favorable. CLSA has a high conviction outperform. They find the valuations attractive. And IIFL says that earlier the target price assumed some probability that Vodafone Idea doesn't survive. Now they have made that probability zero. They're sure Vodafone Idea is going to survive. And therefore, the target price for by IFL on Industars also goes up. And they're saying that in all the scenarios now, the downside for Industars is protected from here on. So this is just a compilation of what brokerages are saying.
In fact, listening to that, I guess the shareholders of Vodafone Idea would be more happier that the probability has been put down to 0. But Reema, thank you for summarizing that big story for us.
The big story is also
the big stories are playing out on our screens as well, indeed.
Right
and still no update on the resumptions of trading for MCX. It's been 3 hours now. And the recent update also continues to mention the same, that trading has been delayed due to a technical glitch. There has still not been any form of attribution as to what led to the glitch, what has exactly been the glitch, and when is it likely to be resolved. So a lot of unanswered questions with regards to MCX. Trading still remains halted. It's been 3 hours. And
I think Sudarshan was saying the last time there was such a trading glitch and a trading halt was in February of 2023, where a system malfunction caused a 4-hour trading suspension, reportedly linked to the exchange's migration to a new trading platform. So
we're getting there almost for 4 hours, but still 2% lower on the stock. Now at the lowest point of the day is MCX. Take your leave on this edition of Trading Hour. The Nifty still down 100 points. From Reema, Sonal and me, thank you for watching. Halftime report on the other side.